Imagine sitting in a quiet American neighborhood, the leaves turning golden in autumn, the streets calm, and the weight of a lifetime of work behind you. You've spent decades building your career, paying your dues, saving money in retirement accounts, and planning for the day when the 9 to 5 would finally be behind you. Retirement was supposed to be the reward, the golden chapter where you could finally live with dignity, enjoy freedom, and spend meaningful time with loved ones. Yet as many retirees soon discover, there is another challenge quietly waiting at the doorstep: taxes on retirement income. For many, this comes as an unpleasant surprise. The money you carefully set aside, the accounts you faithfully contributed to, and the benefits you earn after years of service, all suddenly feel smaller once the government takes its portion. It feels as though you are paying twice on the same dollar, once during your working years and again when you finally need it most. The frustration is real. But what most people don't realize is that there are perfectly lawful, ethical, and practical ways to reduce that tax burden. The United States tax code, while complicated, actually provides opportunities for those who understand it. This is not about trickery or loopholes. This is about making informed choices. The kind of choices that can protect your retirement nest egg and ensure that your savings last as long as you do. Picture a man named Michael. He worked in Texas as a high school teacher for more than 3 decades. Every month he contributed to his 401k, never skipping a payment, believing it was the safest path toward retirement security. When the time finally came, he looked forward to withdrawing his funds and living comfortably. But on his very first withdrawal, he was stunned. Nearly a fifth of the money he thought was his disappeared in taxes. Combined with Social Security benefits, his withdrawals pushed him into a higher bracket. Instead of enjoying freedom, he felt weighed down by rules he didn't fully understand. Michael's story is not unusual, but it doesn't have to be repeated. Now imagine Sarah, an engineer in California. Early in her career, she chose to invest part of her savings into a Roth IRA. It meant paying tax upfront, which wasn't easy, but she was patient. Over the years, her Roth grew silently, untouched by tax collectors. When she retired, she withdrew freely, every dollar flowing into her account without a portion claimed by the government. While others worried about shrinking checks, Sarah enjoyed peace of mind. Her foresight gave her an advantage many wish they had. This contrast highlights an essential truth. Not all retirement income is treated equally. Some streams are taxable, others are partly exempt, and a few are completely tax-free. The secret lies in understanding the categories and arranging your income sources wisely. Social Security, for example, can be taxed up to 85% depending on your total income. Traditional 401k or IRA withdrawals are fully taxable. Roth accounts, on the other hand, allow tax-free distributions. Pensions vary depending on the state. Investment income like dividends or capital gains is taxed differently depending on how long you hold assets. And then there are annuities, each with its own rules. The system is complex, but within that complexity lies opportunity. One of the most effective opportunities comes from Roth accounts. Think of them as a garden. You plant seeds with money that has already been taxed. Over the years, the garden grows and flourishes. When the time comes to harvest, no one demands a share. It is all yours. The key advantage is control. Unlike traditional accounts, Roth IRAs don't require minimum distributions at age 73. You can leave the money untouched for as long as you like, letting it grow or passing it on to heirs. This flexibility not only reduces taxes, but also provides dignity and choice in your later years. But savings vehicles are only one piece of the puzzle. Another powerful factor is geography. Where you live in America dramatically influences how much of your retirement income you get to keep. States like Florida, Texas, and Nevada have no income tax. Retirees in these states find their withdrawals stretch further. Contrast that with places like California or New York, where high state taxes take another slice of your income. The decision of where to spend your retirement years can literally mean thousands of dollars of difference annually. Consider David. After working in New York City for decades, he dreamed of retiring in the same neighborhood he had always known. But when he calculated the taxes, he realized staying would drain his savings far quicker than he expected. The choice was difficult but practical. He relocated to Florida. With no state income tax, his retirement checks stayed fuller, and his money lasted longer. For David, moving wasn't about running away. It was about protecting the dignity of his retirement. Timing also plays a critical role. Retirement income is not just about what you withdraw, but when you withdraw it. Imagine a person who retires at 62, but delays Social Security until 70. During those years, their income might be relatively low, creating a window of opportunity. They could withdraw from traditional accounts at lower tax rates, or even convert some funds into Roth accounts. By using those early retirement years strategically, they prevent higher tax brackets later in life. This is like playing chess with the tax code. Each move matters, and the order of moves can determine how much you ultimately keep. Another overlooked strategy involves charitable giving for people who are generous by nature. Qualified charitable distributions allow them to donate directly from an IRA. Once they reach 70 and a half, these distributions don't count as taxable income, yet they still fulfill required minimum distribution rules. In essence, you support causes you care about while reducing your taxable burden. For someone of faith or anyone committed to community support, this is a meaningful way to align values with financial planning. Beyond accounts, geography, timing, and charitable giving, there is also the question of diversification. A retiree who depends on only one income stream may find themselves trapped by taxation rules. But those who spread savings across Roth accounts, taxable accounts, and even municipal bonds create balance. Municipal bonds, for instance, often pay interest that is exempt from federal tax, and sometimes from state tax as well. For a retiree looking for steady income, this can be a safe and tax-efficient option. Picture Linda, a nurse from Ohio. She diversified her savings early, placing part of her funds into municipal bonds, part into a Roth account, and part into a traditional IRA. By retirement, she had flexibility. In years when she needed more money, she withdrew from her Roth, avoiding extra taxable income. In other years, she tapped into her bonds, enjoying interest that was federally tax-free. By balancing her sources, she avoided being trapped in high brackets and preserved her lifestyle with far less stress. At its core, avoiding taxes on retirement income is not about escaping responsibility. It's about knowledge, foresight, and discipline. The system is designed with options, but only those who understand and use them benefit. Too many retirees walk blindly into taxation traps, losing money they could have lawfully kept. But with planning, it's possible to enjoy retirement the way it was meant to be: peaceful, secure, and dignified. Think of retirement as a long journey, not just a destination. When you finally leave your career behind, your income no longer comes from a paycheck. Instead, it comes from the decisions you made decades earlier. Some people find that their money stretches comfortably, while others discover their nest egg shrinking faster than expected. The difference often comes down to one factor: planning for taxes. Take the case of Robert, a factory worker in Ohio. He spent 40 years contributing to his traditional 401k. Every paycheck, a portion went into the account before taxes, and he never thought much about it. When retirement came, he had a sizable balance, but the shock hit when withdrawals began. Each distribution was fully taxable as ordinary income, combined with Social Security. He was pushed into a higher bracket, and nearly a third of every withdrawal was eaten up by taxes. The retirement he had envisioned felt suddenly smaller. Now compare Robert with Maria, a pharmacist from Arizona. She split her contributions between a Roth IRA and a Roth 401k. At the time, some colleagues questioned her choice because she paid taxes upfront, but Maria thought long-term. When retirement came, her Roth accounts allowed her to withdraw freely without adding taxable income. Her Social Security remained largely untaxed, and her savings lasted longer. The difference wasn't luck, it was strategy. One of the most powerful ways retirees manage their tax burden is by coordinating when to claim Social Security. Many people rush to claim at 62, worried they might not live long enough to enjoy the benefit. But for those with other savings to draw on, waiting until 70 can mean larger monthly checks. And when withdrawals from tax-advantaged accounts are planned carefully during the waiting years, the overall tax picture improves. It's a balancing act. The more deliberate you are with timing, the more control you have over your taxable income. Another key approach involves understanding required minimum distributions. Traditional accounts like IRA letters and 401ks force you to begin withdrawals at 73. For many retirees, this creates a tax spike they didn't anticipate. But by doing partial Roth conversions in your 60s, moving money from a traditional account into a Roth and paying tax at lower rates, you can avoid massive taxable withdrawals later. Imagine the relief of knowing that when those mandatory years come, you're not forced into higher brackets because you prepared early. Consider Evelyn, a retired nurse. She converted portions of her IRA into a Roth account every year between ages 60 and 65. keeping her income just under the higher tax bracket thresholds. By the time she turned 73, her required minimum distributions were far smaller. Meanwhile, her Roth account continued to grow, providing tax-free withdrawals when she needed them. Evelyn's foresight turned what could have been a tax headache into a smooth financial journey. But what about people who don't have Roth accounts? For them, other tools exist. Health savings accounts, for instance, offer a triple benefit. Contributions are tax-deductible, growth is tax-deferred, and withdrawals for medical expenses are tax-free, since healthcare is one of the biggest costs in retirement. This strategy allows people to cover medical bills without triggering extra taxable income. A person who carefully funds an HSA during their working years effectively builds a safety net that shields them from both medical, inflation, and unnecessary taxation. Geography continues to play a role as well. Imagine two couples, both with identical retirement savings. One lives in Illinois, the other in Florida. The couple in Illinois pays both federal and state tax on their withdrawals, while the Florida couple pays only federal tax. Over 20 years, this difference amounts to tens of thousands of dollars. Choosing a tax-friendly state doesn't just save money, it can redefine the quality of retirement life beyond state borders. Even the type of investments you hold matters. Municipal bonds, often overlooked, can provide steady interest that is free from federal tax. Some states even exempt their own bonds from state tax. For retirees who want reliable income without additional tax burdens, municipal bonds can be an elegant solution. They don't carry the excitement of high-growth stocks, but they bring stability and efficiency qualities that matter more in retirement than in youth.